The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Live from Studio 2 at Bloomberg World Headquarters in New York, I'm Scarlett Fu.
And I'm Bonnie Quinn. We're counting you down to the closing bell here in the United States. And let's get a quick check on those markets, Scarlett. So we are seeing highs of the session for the most part for the S&P 500 up 0.7%, and the Nasdaq 100, I don't want to say roaring back, but it is up 0.4%. A little bit of optimism perhaps over this potential EU-US trade deal coming in at 15%. This according to some EU diplomats to Bloomberg. We are seeing also a bit of weight. The curve is higher across the board, a little bit higher at the short end than the long end. 2-year yields are up about 5 basis points. 10-year yields up just about 4 basis points, and a little more weightiness to the dollar index throughout the session as well. We're now down about 0.25%, Scarlett.
And it all comes back to let's make a deal. The European Union and U.S. moving closer toward a trade agreement just hours after the White House announced terms with Japan. We saw stocks extending their record-breaking run, while declines in bonds and the dollar reflect a lack of demand for haven assets. Treasury Secretary Scott Devitt credited Tokyo's pledge to invest hundreds of billions of dollars in the U.S. for getting the deal across the finish line.
I think it's very important to know that 15% for Japan for reciprocal tariffs for autos, that is a different kind of deal, but because the Japanese proposed a very innovative solution.
Earnings will now determine whether the market rally continues or takes a pause. A pair of Mag 7 names, Alphabet and Tesla, set to report after the closing bell, with other names like legacy tech company IBM, gaming giant Las Vegas Sands, and railroad CSX also on deck. Alphabet and Tesla now have both lagged their big tech peers, but signs of tangible progress on AI and autonomous vehicles could silence their critics. And AI is also the big theme in Washington, with the White House releasing an AI action plan. The Trump administration is urging more development of the technology by loosening regulations and expanding energy supply for data centers. The new guidelines are aimed at ensuring American technology remains the foundation for AI around the globe. And Bonnie, of course, we come back to trade because that's what's been kind of the undertone here for this market run. Exactly, and we have a long way to go, Scarlett, in spite of these headlines about Japan. Of course, yesterday we had the Philippines and so on, so we might have a little bit more clarity when it comes to some of the Asian nations. If you look here, Japan is one of the better nations in terms of what tariffs are going to be slapped on it. We had Indonesia and Philippines coming in at 19% as opposed to the 20% after the Philippines visit yesterday. But I do want to point out that Goldman Sachs has now upped its estimate for what reciprocal tariffs will be to 15% from 10%. And earlier in the week, JP Morgan said with the addition of these new tariffs on Brazil, Canada and Mexico, which were not anticipated, also the copper tariffs at 50%, which were not anticipated, that's brought JP Morgan's estimate for the baseline effective across the board tariff to over 20% from at most 15%. So it's very clear we're not out of those woods yet, Scarlett. Yes, but we are making progress towards that August 1st deadline, if indeed that is a hard deadline here. So let's kick things off with Todd Sohn. He is Senior ETF and Technical Strategist with Strategas Securities. Todd, always a pleasure to see you. And we went through all the tariff numbers, or the latest tariff numbers. But what's really underpinning this rally is that it's been going on for a while, and it's pretty broad-based. In fact, you have a statistic that shows this 3-month percentage gains is pretty much not unprecedented, but it's one of the largest that we've seen in a while.
We are in the cream of the crop in terms of the response off of the April 8th low, right? One of the best 3-month percentage change in the history of the S&P 500.
Okay.
Top 10 at least. What does that mean? Historically, similar observations. The next 1 to 3 months are a toss-up. So far, things have been good. But the next 6 to 12 months, very bullish, very strong hit rates. It tells you that April was a meaningful low and that we're going to continue this bull market higher. Okay. In terms of leadership, we've seen big tech take the mantle once again. Of course, earnings are on deck, so that will determine a lot of it. But what are you seeing in terms of leadership that gives you confidence that this rally will continue? Yeah, so we have the great rate of change, right? We have the great historical comps, but you're also seeing with pro-cyclical leadership, discretionary is outperforming staples, and now you're getting the home builders involved, which is really good. Semiconductors are back on the field. Yeah, they could pause here. That's okay. And then you still have a global bull market. We had this trade deal, and the response from Japanese equities is one of the best they've had in quite some time. So I like the leadership. There's no signs of defensive, which could be a little bit of a risk. But it's too hard to fight that trend of this market when you have such good leadership.
Do say it could be a toss-up for the next 1 to 3 months, though, after such a bull market run. I mean, what do I want to be doing in a toss-up? Should I just head away for 3 months?
You stay the course. You don't get too scared of pullbacks. But I think you at least want to say, all right, where in my portfolio am I a little offsides? I am concerned that you are seeing defensive sectors in the S&P 500 just completely disappear. Healthcare, staples, utilities, and energy are less than 20% of the S&P 500. It's a 35-year low, so you have to think differently about what to do. Maybe you want to add some managed futures or international stocks, which have better valuations, right? So just stay the course, but say, where do I need to kind of get a haircut in terms of my portfolio?
How would you even begin to go looking for some kind of managed futures products if you were just looking for something defensive? Oh,
we have ETFs for that.
Yeah,
ETF,
sure.
Right? There's 4,200 ETFs. Managed futures is a pretty popular category now. You're seeing a lot of the big issuers come into the space. They all have their different nuances in terms of how they position, so that requires a little bit of due diligence, but they're out there. And their fees are coming lower and lower. You can get a managed futures product from, say, Invesco for 65 basis points.
Sure, but aren't they attached to those parts of the market that you're saying are not defensive?
So what they'll do is they will buy futures. They can buy rates, commodities, FX, right? They're uncorrelated, I think, is the key word there. They're not going to trade like stocks. They can be a shock absorber. So if the market were to correct out of the blue, ideally those products will jump higher during that volatile environment because there's some other macro input going on. It's all about the uncorrelated aspect to equities.
Speaking of looking for something defensive but having it hide in something very growthy, what about Bitcoin or crypto specifically? There's lots of ways to get exposure to that, including through Bitcoin treasury companies.
Right. So this is interesting to me. I think you're seeing mainstream really adopt crypto here. I can see it. I can understand why you'd want to allocate to it. You almost have to be there at this point because everyone is talking about it. If there is one aggressive sentiment point, I do think that crypto ETF flows are starting to say things are getting a little bit offsides, right? Since the April 8th low, our category workbook has been led by Bitcoin ETFs. And now you have these Bitcoin treasury companies that are coming about. That's another way to play the space. So I wouldn't want to fight Bitcoin. The trend is clearly up there. But if you want to ask me to name one place that's aggressive, it's crypto a little bit. So I can understand it for a diversification standpoint, but I'm a little weary on the sentiment.
Okay, so you're looking at that with a raised eyebrow there.
Yes.
In terms of global allocation, we've seen global equities outperform the U.S. market. Is that divergence going to continue? I mean, how much more room rate is there?
A lot.
Really?
Because you think about how much underperformance has been from global stocks over the last 20 years, right? And I would not go underweight the U.S. to the rest of the world. That's just too hard of a bet. But if you have had 0% or 5% international exposure, you have to raise it to, say, 10.
It's not too late.
It's not too late. Europe stocks just broke out of a 20-year range. Japanese stocks have barely worked in 30 years. And what's interesting about them is they have a much different constituency. It's far more industrial heavy. And we're talking power and AI derivatives. There's far less tech, and then there's a fair amount of consumer stocks there too. You have video games, autos, luxury goods. So you're getting a differentiated exposure there, and I don't think it's too late. The valuations are still supportive. So if you're just looking to get away from large cap growth in the U.S., international makes so much sense here. Yes, they've run in the last year, but think back the last 20 years, they've gone nowhere.
So you're still okay with Europe and Japan. What about the likes of China or in India, which saw a huge run-up at one point, even in South Korea?
So I like Korea. Korea is interesting. We think Samsung has formed a major bottom, right? That's a sleeping giant. It's a massive semiconductor electronic company. Korea has really surged here. I'm less enthusiastic at China. It is working. But China over the last 30 years has returned 1% annualized, so it's a volatility machine. I think if you wanted to play China, you can use the material names, material stocks, BHP, Rio Tinto, Vale. That's the better derivative and perhaps a little bit lower volatility to play China than direct Chinese equities to me.
And of course, with the U.S.-Japan trade deal, people are looking for Korea to be the next one to get something going. All right, Todd, always appreciate your joining us. Thank you so much. Todd Sohn, Senior ETF and Technical Strategist with Strategas Securities, kicking us off as we count you down to the closing bell. Coming up, meme stock euphoria spreading to a broader group of stocks as traders latch on to companies that online personalities are now endorsing. What does this frenzy tell us about market confidence?
Well, and those so-called meme stocks, all the rage on Wall Street. AI, also all the rage in Washington today. We'll break down the Trump administration's latest AI action plan and see what it means for the future of American tech innovation.
And speaking of AI, we've got you covered on Alphabet and Tesla, which report results after the closing bell. Key stakeholders, including a former executive, a shareholder, and industry analyst, join us in the lead-up and the aftermath of those releases. All that and more coming up. This is The Close on Bloomberg. Meme stocks are back in vogue with shares of GoPro, Krispy Kreme, and others surging in today's session. A healthy mix of social media hype, short squeeze action, and favorable technicals do seem to be driving the moves. But like with the 2021 meme stock mania, really, the name of the game is volatility. Kohl's and Open Door, for instance, down sharply after big swings up yesterday. Let's now bring in Peter Atwater. He is president of Financial Insyghts and author of The Confidence Map. Peter, always a pleasure to speak with you. What does the return of meme stocks tell us about sentiment overall?
So meme stocks, Scarlett, are the guest that only arrives at the party when the bar is fully stocked and people are ready to celebrate. And so to me, this is yet another indication of a market that is in full euphoria.
It's in full euphoria, and we've seen how these retail investors target heavily shorted stocks that have already been beaten down. And in 2021, they were really focused on names that hedge funds were shorting, kind of to stick it to the man. Hedge funds have, wised up, and they no longer talk so publicly about the stocks that they're targeting. What do you think is behind the motivation to continue pumping up heavily shorted stocks?
They're completely vulnerable in this situation because everything else is extremely valued, and you have at the other side of the spectrum things that nobody wants, is disinterested in, and they really become targets unto themselves. And what's so fun about this moment is you have this, mess around and find out attitude that you only see right at these kinds of inflection points in the market.
Peter, who exactly is making the quote-unquote returns, though? If you look at Krispy Kreme, it closed on Monday at $10.42. It opened on Tuesday already at $19.75, and it didn't get much beyond that. It spent practically the whole rest of the day coming down. So who traded pre-market? Is it really the retail traders doing that?
I'm not sure who's making money in this. To me, it's more the amusement of it all, because it's such a sentiment indicator unto itself that you have these names that, to your point, explode in price 100% overnight, and then people try to chase it only to effectively catch a falling knife.
Also, how do we know, and how do traders out there know how much is short sold on a daily basis? Do you have to have sort of access to special information to find that out?
I'm sure that the hedge funds and the brokerage firms like Citadel have a very good feel for, how folks are positioned. But I think for the retail investor that is playing this, it's an opportunity to buy a lottery ticket. These are fun and games. People have made a lot of money, particularly in this market, as your last guest highlighted. We've had this bungee jump vertical rise after the April lows, and so there's money to play with. This is funny money for many retail investors.
Yeah, according to Citadel, retail traders were net buyers of cash equities for the past 19 straight trading sessions. That is the longest streak we've seen since the 2021 meme stock craze. Peter, you have become an expert on confidence. You look at studying its impact on consumer and organizational decisions, group decision making. Is the return of meme stocks something that inspires more confidence, or is it merely a reflection of confidence? Does it drive confidence?
No, I think unquestionably this is a reflection of it. And more, what I love about this latest version is investors are pointing back to the early parts of 2021 as if to say there's another 12 months still to go, because back then the market didn't peak until 2022.
Okay, so they're basing this on recent history as well as continuing to push these stocks higher. In the past, we've seen different companies' management capitalize on the big bump up in their share price by selling shares to raise money, for instance. What else does that playbook entail? What might we anticipate from the companies as some of these day traders anticipate this meme stock mania lasting perhaps as long as another year?
I think if you're a company whose stock has been beaten down, you want to make sure that you've got the opportunity to take advantage of an unexpected rise. If you're issuing equity, there are only two times to do it: when you have to and when you're stupid not to. And the meme market gives them that latter opportunity.
But Peter, this is very, very different, no? I mean, back then there was some kind of ethos behind it. There was some kind of stick it to the man. The only way to beat them is for us all to band together and sustain this rally so that everybody can make money. Right now, it seems to be like nobody is making money except, as you pointed out, the hedge funds that have extra information, the Citadels and so on. Is this not perhaps potentially a pump and dump scheme?
You know, I think all of these meme moments, whether it was meme stocks in 2021, meme coins at the beginning of this year, create this frenzy of excitement in things that are of questionable value. And so, yeah, it runs the risk of being, in hindsight, a pump and dump in many things that catch a lot of retail investors, unfortunately, in that process.
Yeah, but everyone's smart. They always get out before that moment, right? That's the thinking. Peter, thank you so much for joining us as always. Peter Atwater is president of Financial Insyghts. He is also author of The Confidence Map. Now, coming up on the close, Chipotle results will be due out after the closing bell. You can see they're up by about 1/3 of 1%. Morgan Stanley's Brian Harbour will join us next to give us his preview on what to expect. This is The Close. Time now for our top calls and look at some of the big movers on the back of analyst recommendations. And we'll start with Lockheed Martin. Truist cutting the stock to hold from buy and slashing its price target by more than $100 to $440. The downgrade comes after the world's largest defense contractor reported earnings that missed analyst estimates and lowered its full-year outlook. The shares nonetheless up by more than 2%.
Next up, Toll Brothers, Seaport Securities upgrading to buy from neutral and setting a price target of $161. The firm shifting to a more positive stance on home builders and foreseeing declining new supply and margin stability for Toll. The analyst action also follows D.R. Horton and Pulte Group's better than expected results yesterday that sparked a double-digit percentage gain. Shares of Toll Brothers, you can see, up fractionally now.
And finally, Tyson Foods. Bernstein reducing its rating to market perform from outperform and lowering its price target to $59 from $74. The analyst cites concerns that Tyson's beef business may continue to face unprofitability in the short term because of cattle supply challenges. The share is down by about 0.7%. And those are some of our top calls.
Now we're going to stay in the food space now and focus on Chipotle. Shares there up about 0.4% as the largest fast casual chain in the U.S. prepares to report results after the bell. Joining us with a preview now is Brian Harbour, U.S. restaurants and food distributors analyst at Morgan Stanley. So let's start with the summer offerings. Brian, how are we doing when it comes to, the summer of extras for Chipotle?
Yeah, thank you guys for having me. Look, I think that this is going to be a tough quarter in absolute for Chipotle, but I think the important thing here is some of those summer deals, summer marketing, I do think that's starting to have an impact, right? So I expect that they'll have exited the quarter certainly better than they started. And I think we're still pretty optimistic about how things shake out, in 3Q and 4Q, for example. But, we obviously have to get past a tough 2Q here.
Absolutely. The other innovation, and Chipotle is, hell-bent on continued innovation, has been the Chipotlanes, right? Has that been a success, and will that be to the detriment of Chipotle if it has to continue to spend more on land, essentially, to have more of these Chipotlanes?
I think certainly the Chipotlanes have been a success, right? And they'll continue to build most of their stores with those. The fact is that sort of convenience where people can come and sort of pick things up in that fashion, I think people really like that, right? The question is sort of how does Chipotle continue to drive digital sales? Because I think it's a very attractive channel for them. It's generally attractive from a margin perspective. So I do think you'll hear them continue to talk about that and lean into it over time.
In terms of spending overall, especially on equipment deployment, that's, of course, aimed at increasing efficiency. But what kind of spending does that lead to for the second half of the year and into next year?
Well, look, I think it's pretty modest CapEx that's sort of going into stores as you replace some of that back-of-house equipment. You should see the benefit of that in margins. You should see it in store efficiencies. I think you'll see some labor savings from that over time. In fact, it's really a key part of the path back to margin expansion that we've forecasted as you look over the next year or so, right? I think beyond that, we start to talk about things like Autocado and Hyphen. Those are still in test right now, but those could be very interesting tech drivers, as we look out sort of multiple years, right?
So what does the company want its post-Brian Niccol theme to be when it presents to investors? What's the takeaway for investors here?
Well, look, I don't think anything's changing drastically from when Brian Niccol was there, right? I think this was a company that was doing very well at that time. What you are starting to see is the new CEO put more of his stamp on the company in the year that he's been in that seat, right? As we've seen new marketing campaigns, I think you're seeing a faster pace of innovation. I think you'll see, some focus on service that perhaps has evolved a bit, as well as some more things with digital and loyalty. All of those are things that he's putting his stamp on. So it's doing what Chipotle does, but, sort of better in some ways, right?
The international expansion will be something that investors will be really listening out for on the call today, I imagine. Brian, how do things like avocado, cilantro, poblano peppers, all the things that make Chipotle Chipotle, how do they complicate the international expansion picture in an era of tariffs and, shortages and so on worldwide?
Well, look, I think supply chain is certainly something that you have to focus on a lot as you're building that out. International is very small for them right now, and I think you're going to see it grow very gradually. And part of that is because they have to sort of build out that supply chain. All those things are obtainable outside the U.S. We've seen them open in the Middle East with actually quite a bit of success, but it's just a handful of stores open right now. So I think we are excited about that prospect. But this is something, I think we're going to be talking about over 5 or 10 years. I don't think it's something where, for example, we open several hundred stores next year, for example.
And then when it comes to the consumer, we spend a lot of time trying to figure out just how under siege, particularly the lower end consumer is. How much will Chipotle talk about that? How much are they seeing, a change and a shift, say, to the convenience store as opposed to the Chipotle in the evening for a typical consumer?
Yeah, I think that's part of the explanation for why things have slowed a bit when you sort of compare it to 2023 and 2024, right? When the data that I've seen, there is a little bit of pullback among the lower end customer. And look, that's true across the industry, right? If you look at, why have quick service restaurants broadly seen relatively slow trends lately, I think it's largely because of the low end. That group is still very inflation affected. I don't think that's changing rapidly. It'll certainly be a question, for them tonight as to whether that's sort of stabilized, whether things have picked up. I think we have a view that it's probably stabilized, but is that becoming sort of a positive contributor to their growth going forward? I think we have yet to see that, right? And, if you talk to my economics colleagues, they still expect inflation to pick up a little bit. So that pressure, especially on that customer, isn't going away.
All right, Brian, well, we will be watching out for those results later. And again, Chipotle down almost 13% year to date. Our thanks to Brian Harbour, US Restaurants and Food Distributors Analyst at Morgan Stanley. Coming up, we're less than an hour away from Tesla's 2Q results. We'll be speaking with Karim Bousta, partner at DVX Ventures and a former Tesla executive. This is The Close on Bloomberg.
It is just about 3:30 p.m. here in New York. This is the Countdown to the Close. I'm Scarlett Fu.
And I'm Molly Quinn. And Scarlett, I just have to talk to you a little bit about the shares of Tesla because we're back at $333 a share. You know where you were last August? We were below $100.
It's been on such a ride.
It's it's a phenomenally difficult task to predict what Tesla is going to do. So for anyone out there with a price target on it, I am just in awe. I mean, the beta on this stock is 1.59. The metrics have been all over the place if you compare the last couple of years to this year. And we're talking about a return on equity now below 9%. Days inventory are up. There's all sorts of headwinds coming down the pike, and still investors seem to want to buy this stock.
The thing that's amazing about Tesla to me is that car sales still generate about 85% of its revenue, but that does not drive the stock price action, right? We know that car sales are slowing down, but that doesn't matter. It's what Elon Musk says about autonomy, autonomous vehicles, about the humanoid robot, all of that. That's what drives the stock price.
And it's also the mystique of the Tesla itself, right? I really
Is there mystique still, though?
I think there still is. And I really do wonder if Elon Musk were to step away and there were to be somebody else completely in control, just how much of a key man risk is there baked into the stock right now? I don't know. Maybe we'll ask our next
guest. Or key man benefit. Who knows at this point if he gets replaced.
Well, let's ask our next guest about this. That's Karim Bousta, partner at DVX Ventures and a former Tesla executive. So, Karim, just on that point, is there an Elon Musk sort of premium or discount in this stock at the moment? And if so, to the tune of how much?
I don't think we can talk about discounting. I think if you look at the history of Tesla, it's very clear that all the great things that have happened at Tesla, the innovation, the incredible products, the success that the company had over the past decade, It all comes down from Elon's product vision, his very powerful vision, his strategy, and his leadership and his ability to bring great talent into the company. I don't think these things have disappeared. There's a lot of headwinds, as you mentioned, that the company has to deal with, essentially because of the increased competition. There's incredible competition going on. That's what Tesla has to deal with. They have to go back to the roots of what has made them successful, which is creating amazing products and services that customers love. So
sure.
I think it's going to be interesting to see if they're able to go back to this, what has made them successful.
Just on that point, though, you know, everything you say may be true about how this is all down to Elon Musk and so on. But if you look at Apple, for example, you know, we had Steve Jobs, but then Tim Cook came, took over, and the stock has never fared better. Couldn't that also happen at Tesla?
I think the decision and the assessment in terms of what needs to be done from a leadership standpoint, this all belongs to the Tesla board and the Tesla shareholders. It's up to them, based on the information they have from the inside, to determine what the best course is for the company. What we know for sure is that when you look at creating amazing product and creating amazing services and solutions, there's no better person that we know of than Elon at this time.
Is the car still the amazing product, though? They haven't really refreshed the lineup in a while, and all talk of this lower-priced EV has been just that, all talk. We haven't really seen any concrete plans on when they're going to release any of that.
Yeah, and you're making an excellent point. This is really the key issue for me when I look at Tesla's future. The vehicle lineup is becoming old. Competition has caught up. On many aspects, Tesla is now behind. And it's going to take a lot of effort and a lot of time and resources and energy for them to catch up on all these amazing competitions that we're seeing from the US, from European, and from Asian competitors in China, Korea, etc. So that's going to be something we're going to need to watch. Is the company able to go back to this innovative roots and launch new products to replace the ones that frankly are becoming quite old right now and are falling behind this amazing competition that they're dealing with.
Yeah, you talk about how success for a company that is increasingly a mature business as opposed to a growth business really depends on operational excellence and product innovation. Is that still Elon Musk's forte?
I think this is something that is in the DNA of the company and its leader. I don't think it's something they lose. You can lose. The question is, do you still have the focus and the ability to drive all your attention and your energy to that? One of the challenges that Tesla is dealing with right now is the fact that they've become a mature car manufacturer. They have to deal with the same issues as all other car manufacturers are dealing with: competition, prices, new markets, etc., having to innovate. And at the same time, Tesla has embarked in this new journey of creating a new business model, essentially a new company with the robotaxi service. So doing the two things at the same time is actually one of the big challenges because it consumes your attention and your resources.
Karim,
so that makes it challenging.
Do you see Tesla increasing profit margins over the next several years? Can it do that if it takes down the unit cost per production basis?
I think that's going to be really hard for them. They first have to catch up on the product lineup, as we said, launching new products that customers are going to love, innovating on the technology side, innovating on the manufacturing side. This takes up a lot of resources and capital. And they have to do that in a context where the sales are declining, the profit margins are declining because of the price war that they're not able to offset. So that puts a lot of pressure on the margin. I think we're going to see in the next few quarters declining profit and really challenges for the company to generate enough profit to be able to fund this R&D and this innovation on both fronts, the core business and the robotaxi business.
And then the 15% of revenues that are not from cars and that are not from vehicles, right? It's from the energy business. What do you see Tesla doing with that in the next coming quarters and years?
I think so. One of the things that made Tesla successful was this vertical and horizontal integration, thinking of the EV business not just as making successful and great electric vehicles, but thinking much broadly in terms of the charging infrastructure, the energy business, and thinking of all this in a very consolidated way. So it has to continue being a core and essential to the vision and the strategy for the company. The question again is an issue of focus and resources, being able to develop, invest, innovate in the energy business when you have all the other challenges with the core automotive business and the robotaxi business at the same time. It's really this conflict of resources and attention that makes it really hard for the company.
Feels like it's a case study for business school students then. Karim Bousta is a partner at DVX Ventures. He is, of course, a former Tesla executive as well. Thank you so much. And of course, Tesla will be reporting earnings after the closing bell, and we'll break it all down for you. Now, coming up, Texas Instruments now headed for its worst day in 17 years following a disappointing earnings report. We're going to break down what's happened to the chip maker. It is our stock of the hour. This is The Close on Bloomberg. Today's stock of the hour is Texas Instruments, and shares of the chipmaker dropping as much as 14%. That is the worst one-day decline since 2008 on the heels of a disappointing earnings outlook. TI executives say they're getting more cautious after tariff concerns drove a potentially short-lived spike in sales. Let's bring in Kunjan Sobhani, who is our senior semiconductor analyst here at Bloomberg Intelligence, for more. Kunjan, the company clearly benefited from a front-loading of orders from customers worried about tariffs. Now it's kind of feels like held hostage to how companies react to an ever-shifting trade policy. What can Texas Instruments do to get ahead of that, or it can simply only react?
Well, like I said, it could simply only react. The stock reaction we see is driven in the delta between what was the expectations, which we saw industrial segment keep performing above seasonal over the last 2 quarters. So investors expected industrial to keep performing above seasonal for the second half. And auto was called up almost a bottom last quarter, so auto to continue starting its recovery. Both of those factors didn't really happen. So this difference between expectations or hopes versus reality is what you see in the reaction. And like you correctly pointed out, the company cannot do anything beyond on its own right now, given how the end market dynamics look like.
Kunjan, it really is a case study in how to communicate, post to earnings, right? I'm curious, the CFO said, look, we have 100,000 customers. We just don't know with each one of them if this is a pull forward in demand or if this will continue. I mean, was the CFO right? Because analysts just assumed that was a pessimistic view. Or should the CFO not have admitted we don't know? I mean, should the company know?
I mean, the company, this specific company does have a better idea than most of its peers because of 2 reasons. A, they are a lot more direct to customer selling versus a lot of their peers do through distributions and through channels. So there's a less layer of a middleman between them and the end customers. So they do have a lot more clarity in terms of real demand. And the company has been known, or the management has been known to take a much conservative view when it comes to weakness rather than, putting their neck out and stating something more aggressive. So we think there's also that conservativeness built into this guide.
So Texas Instrument is really the first major semiconductor company to report earnings during this earnings season. And as Vani mentioned, about 100,000 customers. So it's seen as a bellwether for demand across industries. What can we extrapolate from Texas Instruments' results to the other chip makers?
Yeah, so a couple of things, like peers who are heavily reliable on the industrial and automotive end markets, there's a high probability that they might see a similar outcome where they might see really good results in the current quarter, but the outlook might come softer than what investors hoped. So you could see a similar reaction there. We're already seeing shares of their peers drop after Texas responding, so investors are pricing in that risk already. The other factor is, there have been, you saw another peer, NXP, giving bullish or optimistic commentary about their outlook on auto for the second half. So there's some discrepancy between what Texas Instruments said and NXP said. So that is an area investors will keep a key eye on as more companies which have higher auto exposure. What do they come out and start talking about the auto segment in particular?
Kunjan, thank you so much. Fantastic context. That is Kunjan Sobhani, Senior Semiconductor Analyst at Bloomberg Intelligence. And you do have to wonder, Scarlett, I mean, the stock down about 13, 14% at the moment. Was the company right to be cautious, to be very, circumspect about the future and suffer the consequences now, and perhaps that, stock price will recover if things look rosier, and if things stay weak, then you can't suffer much more?
At this point, so many companies have been caught up in this dilemma, and they end up being cautious, and that's kind of paid off as more trade deals get signed. I do wonder, though, with Texas Instruments so heavily reliant on China, about 1/5 of its sales, if we get more details on a China trade deal, whether that's going to be a source of support for the stock.
Sure, or they did say that demand was 32% from China, and that was a little bit suspicious. It was a little bit too high, so we'll see. Coming up, we're going to be speaking with Katrina Dudley of Franklin Templeton. This is The Close on Bloomberg.
So far, things have been good, but in the next 6 to 12 months, very bullish, very strong hit rates. It tells you that April was a meaningful low and that we're going to continue this bull market higher.
Todd Sohn, Senior ETF and Technical Strategist with Strategas Securities, kicking off the show. And what he said, Vonnie, was fascinating, in that this was one of the strongest 3-month % changes in history. But what happens next is really a toss-up.
Yeah, which is terrifying. You don't really want to be involved if it could go one way or the other, right? But then he did point out that after that toss-up period, it's going to be another bullish period again. So, I mean,
just hang on until then.
Yeah, or pull your money out. I don't know.
Well, that's not happening today.
Certainly not happening today. If you look at the S&P 500, we're up 0.7%, and that's before some of those big earnings hit after the close, including Alphabet and Tesla. The Nasdaq 100 is also improving throughout the session, up 0.3%. Now, of course, we did get that headline earlier about the EU and the US potentially moving closer to a deal, which would be a 15% tariff. That was from the EU side, from some diplomats to Bloomberg. And then we have a little bit of weight on treasuries with, yields up 3 to 4 basis points across the curve, particularly at the front end. I think they were up almost 5 basis points for the 2-year yield. A little weight to the dollar again, quelle surprise, right, Scarlett?
Yeah, absolutely. Well, we'll continue this discussion here and take a look at what's ahead with Katrina Dudley, Senior Investment Strategist at Franklin Templeton. And Katrina, you heard what Todd Sohn was saying earlier. Clearly, lots of momentum here with a heavy dose of choppiness involved as well. What parts of the fundamental backdrop support the bull case here?
I think you want to actually debunk that into 2 parts. The choppiness is actually very difficult to predict when we're going to come into choppy waters. Look, the likelihood is that we will have a correction. We've had probably 3 years of return, and in about 3 months, there's been a rise of the S&P off that bottom. It's up 30%. I think the Nasdaq's up almost over 40%. So you've had very significant moves. So you can have a correction. I'm not sure you're going to have a correction that looks like choppy waters, or rather you just have one big drawdown. The technicals also do support that. August, seasonally weak month, people are away on vacation. But the bullish outlook is there. And I think that people have, we've ingested a lot of tariff news. We look like we're getting certainty on that. We have the tax bill has been passed. And I think that there's a lot of that they were the 2 negatives as we went into the year, and a lot of the uncertainties. And now we're looking at a good economic setup. We're looking at the consumers starting to spend again. And so I think that you've got a lot of just good economic momentum, and where that's showing up is just in the broadening of the stock market.
Yeah, you look at what's happening in the market action today, and the Russell 2000 up 1.5%, the S&P 500 gaining 0.7%. So clearly, anyone going in on this idea that the economy is getting better, that's being reflected in the price action.
Yes, and you're seeing that. I think that the risk in a lot of what is being discussed today and yesterday is the meme stocks.
Yep.
And what's happening that, I think someone called it the rally of the crap, and some really interesting terminology being used by different peers here. But I think that, investors are kind of going into the more risky parts of the market. That is part of a broadening theme. We are thinking that broadening is actually, you can broaden into quality, and you can broaden into upgrading the quality of your portfolio. And also, you can actually broaden away from the Magnificent Seven, because the performance of those stocks is not so great this year. I mean, actually, less than half of them have outperformed the S&P.
Aren't we just one headline away, though, from something that might look like Armageddon? I mean, a couple of times this year we've had headlines we were not anticipating, and the market went crazy.
Yes, you're right. The first one being the tariff announcement. I mean, that was and it's interesting because we actually knew the announcement was coming out, and it was the scope and magnitude of it that was so surprising to the market and caused that sudden sell down. There is always the risk of the kind of unknowns that could happen, but I think that the thing that gives us a lot of confidence is the fact that the market has actually ingested a lot of bad news on the war front and on the the geopolitical uncertainty. We've had a lot of negative things that have just been ingested by the market, and it's telling me that the positioning is moving. It's been very bearish. It's probably moving more out of that bearish camp, but it's not necessarily yet in bullish category.
So Katrina, riddle me this: we get a weak employment report. What happens? Does the market rally because we're looking at potentially closer or more rate cuts, or does the market start to sell off because we're looking at recession?
Well, if you have a look at a weak employment report, the first is why. And everything. So if we're losing workers because we're replacing with AI, actually we're going to have earnings be better than expected despite the employment kind of selling off. And then the question is, how quickly can we redeploy those workers? Because there's parts of the economy where we actually need those workers with some degree of retraining. So I actually would say we want to understand a little more of the why. However, if it's just the wholesale layoffs, that kind of blanket type of employment cut that says we see a lot of bad news on the horizon, I would actually say that is bad for the market, because we've done that linking between a good economy is what's supporting the market at this stage.
Although if there is bad data on the labor market, that could give the Fed reason to cut rates. How much are you paying attention to the drama surrounding Fed Chair Jay Powell and the kind of shock that it may trigger in the market?
I don't think it's going to be a shock to the market in this case, because it's been so widely disseminated.
The shock might be that he stays.
Exactly, it could be, which is a good thing in terms of a rational, a well-functioning market and a well-functioning government. I would say from that perspective, the market's already pricing in. It's a little less than kind of 2%, 2 rate cuts that have been priced into the market. So what does the Fed do? You're coming up against the barrier of time before year end. We've been in the camp that we don't see the Fed cutting rates. If you have a look, inflation is one of the reasons that you would expect. That's under control. The PPI number is actually coming in a little weaker than expected, which also suggests that while we're not going to see a runaway level of inflation, I'm not sure that inflation is as well controlled as the Fed needs for it to cut rates. And then it comes back to the employment question.
What are you hearing from the companies that gives you confidence they're managing through the inflationary tariffs?
I think that what gives us confidence is actually going to come out is the initial earnings reports that we've had so far are showing that companies are beating. And so I think that the majority of companies have been able to handle it. The second thing is that the availability of information and knowledge, and that is something that's very different in this market than it's been when we've had inflationary times before. So I think that they know about it and they're able to adjust.
All right, Katrina, Dudley, always a pleasure. Thank you for joining us today.
Thank you.
Katrina is Senior Investment Strategist over at Franklin Templeton. Of course, it depends what kind of company you are, what your market position is in terms of whether you can absorb those higher costs triggered by the tariffs.
Absolutely, and I think we'll get some kind of a clue today, because we've got 2 of the major companies that we'll be watching out for reporting, Alphabet and Tesla, and some of the others too. I mean, ServiceNow is going to be a good indicator as well of business spending ability.
Right, absolutely, and it's not just tariffs, but also changes to regulation and credits. So especially when it comes to Tesla with those green credits that it counts so much on for its revenue. We're moving you closer to the closing bell here. We've got full market coverage right here on Bloomberg as our colleagues in radio join us right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
We're about 2 minutes away from the end of this trading day. Scarlett Fu and Bonnie Quinn here to help you take you through the closing bell. We've got a global simulcast. Carol Masser and Tim Stenovic in the radio studio. So we are bringing together the best of Bloomberg Television, radio, and our YouTube audiences worldwide as we check out what's happening here in the final minutes of the trade. And Carol, this is very much a market that is gaining steam. The rally picks up here as we head to the closing bell.
Kind of fascinating to see, right? Some buying into the close and, another record, not perhaps. We're going to probably we see another record here on the S&P 500. In the meantime, I'm looking at Alphabet. It's a little bit lower ahead of its earnings release, and Tesla a little bit higher ahead of its earnings release.
The big question I have with Tesla, and we probably won't learn this in the release, is anything related to Elon Musk's commitment or lack thereof to politics. We got that story yesterday about a disclosure and some SpaceX documentation that raised concerns from investors that, hey, wait, maybe he's not done with politics.
Yeah, but we might find out something in the call, right? He'll surely be asked about it, Tim. And if you remember, he used to say things like, well, what I've lost in sales on the left, I've gained on the right, but that's not necessarily the case anymore. And also, if he wants more expansion in Europe, how's Europe going to feel about his politics?
Yeah, that's a big open question. Remember when Tesla was a meme stock?
There's other meme stocks to talk about today.
Exactly, and those are clearly getting a lot of attention, although we're not necessarily seeing it with Open Door and Kohl's, but the rotation continues to some other names, and it really speaks to the level of excitement or confidence that people have in more trade deals being announced and this momentum continuing to the upside.
Yeah, and let's not forget we've got some other earnings. IBM, Chipotle also reporting after the closing bell. Also Las Vegas Sands and CSX, guys.
All right, and of course we'll break those all down for you when they cross. In the meantime, there's the closing bells, and you can see here that the S&P 500 closing right around its session highs, gaining 0.8%, still ticking higher here as we look at a finish of 63.59. The Dow Industrials adding more than 1.1%. The Nasdaq a bit of the laggard here, gaining just 0.6%, and the clear outperformer on the day, the Russell 2000 up 1.5%.
All right, S&P 500, Scarlett, fairly broad-based in terms of some of the buying that we saw today. Fani, 343 names to the upside in the S&P, and you've got 160 to the downside.
If you look at the map of the S&P 500, you would think it was just all green today. It's not. You can see there's a couple of sectors that are in the red, but it's mostly, the likes of healthcare on earnings. Industrials also doing extraordinarily well, and energy having a better day, having had a tough beginning to the week.
All right, guys, as we await for those earnings to cross, Lamb Weston, one of the outperformers in today's session, up about 16%. You know what they do. They make French fries, and investors certainly eating up shares today. It is one of the top gainers. It's actually the top gainer in the S&P 500, surging the most in more than 4 years after it said it would cut 4% of its global workforce, part of a new cost-saving program. And so this company's been going through a few different changes and so on and so forth. So we are seeing certainly investors liking this name. And we got some earnings.
We do. I'm going to just bring up CSX right here as we await the big one, which is Alphabet. This is the railroad company coming in with second quarter revenue that meets analyst estimates, $3.57 billion, just slightly below the anticipated $3.58 billion. As for the earnings per share, 44 cents, which is lower than the 49 cents last year. Operating income for the quarter, $1.28 billion. Analysts were looking for $1.22 billion. And you can see there the shares a little changed at the moment, kind of bouncing around. Was a bit higher. We'll see how it all shakes out. Tim?
Shares of T-Mobile shot higher for a second, then went lower. Now they're higher again, up 2.3% in the after hours. The company sees 2025 postpaid net adds of 6.1 million to 6.4 million. That beats estimates of 5.94 million. The company also sees fiscal year core adjusted EBITDA of $33.3 billion to $33.7 billion. Estimates were for $33.5 billion. So right there. And now we're seeing Alphabet earnings crossing.
We are. And let's start you off with the second quarter revenue of $96.43 billion, I should say, better than expected. $93.97 billion was what analysts were looking for. When you back out the traffic acquisition cost, that is revenue handed over to partners, $81.72 billion, again, higher than the anticipated $79.6 billion. As for the individual business, cloud, revenue there, $13.62 billion, higher than the anticipated $13.14 billion. YouTube ads revenue, $9.8 billion, again, better than the anticipated $9.56 billion as well. Ad revenue, which is, of course, the biggest part of the business, $71.34 billion. Analysts were looking for $69.71 billion as well. As for search and other revenue, $54.19 billion. Analysts were anticipating just under $53 million. You're looking at shares, little change to slightly higher in the after hours. CapEx is another big one, $22.45 billion. Analysts were looking for $18.24 billion. And Alphabet is increasing increasing its investment in CapEx for this full year, Carol and Tim, to about $85 billion. And again, you wonder how much this sets the tone, sets the bar for how much the other Mag 7 names increase their CapEx.
Yeah, exactly. And continue to watch the stock bounce around, now up about 0.9%. Again, some of the big headlines, and Scarlett, you really, draw our attention to them. Company, in terms of CapEx spending, especially amid the AI build out, sees fiscal year CapEx about $85 billion. It's $10 billion than its previous estimate when it had seen about 75. The estimate on the street was a little bit over 73 billion. And again, second quarter Google search and other revenue, that too is a beat, almost 54.2 billion, and the street was looking for 52.8. But right now we are seeing the stock down about almost 1 percentage point here.
Yeah, essentially Alphabet saying that AI is positively impacting every part of its business. And earlier I was speaking with the Goldman Sachs analyst, and he made the point that everything looks rosy for many parts of its business, from YouTube to the cloud revenue, and that's what we're seeing effectively play out in these results, with almost every part of the business beating estimates. That CapEx, though, potentially weighing on the stock.
Alphabet CEO Sundar Pichai calling this a standout quarter, robust growth across the company. Search delivered double-digit revenue growth. He said our new features like AI overviews and AI mode are performing well. We continue to see strong performance in YouTube as well as our subscriptions offering. And cloud had strong growth in revenues, backlog, and profitability. Its annual revenue run rate is now more than $50 billion. Sundar Pichai continuing saying, with this strong and growing demand for our cloud products and services, we are increasing our investment in CapEx in 2025 to approximately $85 billion and excited about the opportunity ahead.
All right, we're going to keep keeping an eye on shares of Alphabet, down about 2% here in the after hours. Quick check on Mattel, also crossing the Bloomberg terminal, and you're looking at this company resuming its 2025 guidance, sees fiscal year adjusted EPS of $1.54 to $1.66 a share, seeing fiscal year adjusted gross margin of 50%. The street was looking for 50.3, so almost in line there. And the company, in terms of the second quarter, adjusted EPS of 19 cents a share, 3 pennies better than what the street was expecting. Their adjusted gross margin coming in better, 51.2%. The estimate was 49.2%. And then second quarter net sales, too, that's coming in light, $1.02 billion. Street was looking for $1.06 billion. Street doesn't like it. Investors setting that stock down about 5.6%.
Also, we should note a correction to one of the headlines, Alphabet's cloud annual revenue run rate over $50 billion. Vani, I know you got your eye on some other numbers that are crossing the terminal right now.
Las Vegas Sands beating as well on all metrics, really, Tim. And it's interesting to see that net revenue coming in at $3.18 billion when the estimate was for $2.83 billion. That stock soaring 6% now. The adjusted earnings per share in the second quarter, 79 cents versus the estimate of 53 cents. And net revenue for Macau was 1.8 billion. The estimate there was 1.77 billion. So really, kerching for Las Vegas Sands on whole metrics.
Yeah, Macau really a star performer there for that company. I just want to go back to Alphabet for a second here, because heading into this earnings report, the stock was on a 10-day winning streak up until today. It had been a laggard compared with the other Mag 7 names, over concern about how Gen AI would eat into its search business, its bread and butter business. But then people were saying, actually the economy is doing fine, so the ad business will hold up fine, and Alphabet has its work cut out for it in terms of reassuring investors over that search business, over the advertising business. Right now, you are seeing the stock move decidedly lower, at least until the earnings call begins, down about 2.5%. Perhaps, Carol, going back to that idea that the CapEx spend is higher than anticipated for the past quarter.
Yeah, I'm going to look for some color and seeing what they have to say about this, because one of the things that we talked about earlier with our Mandeep Singh of Bloomberg Intelligence is a couple of things. I mean, this is a company that has such a massive platform, and that is giving them so much data and information in terms of building out their large language models and token customization, which is something we talk about increasingly. I'm also interested in what this is doing to the tech trade overall. Just looking at the NASDAQ E-mini futures in the aftermarket, up about 0.5%. So it's not like it's pulling down the trade, at least early on.
YouTube ads revenue, $9.8 billion. That's a 13% increase year over year. The estimate was for $9.6 billion. Don't sleep on YouTube.
Don't sleep on YouTube.
No, I mean, this is like this is the competitor to Netflix.
All right. Yeah. So we're watching that. Yeah. No doubt about it. Google down, Alphabet down about 2.5%. IBM just crossing, folks. Let's throw that out for you. Second quarter revenue, it's a beat, $16.98 billion. The estimate on the street is $16.59 billion. And you're looking at second quarter free cash flow. That's coming in better than expected, $2.85 billion. The street estimate was for $2.77 billion. So, do we have the stock trade? Let's just pull it up here on my Bloomberg, and it is down about 2.7% here, Scarlett.
Yeah, the second quarter software revenue, missing analyst estimates, just under $7.4 billion. And as well, the consulting revenue of $5.31 billion, slightly higher than anticipated. But the headline here that IBM is really trying to push is that the generative AI book of business stands at over $7.5 billion. Yet another example of a legacy tech company trying to prove that it is making the transition to this AI generation.
Aggressively, right? Mm-hmm. Trying to pull that out. All right, guys, that's a wrap. Our cross-platform coverage. Still Tesla to come. We should get that in about 10 minutes time. That is a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We call it the closing bell. Vonnie and Scarlett, of course, continuing there on TV, and Tim and I right here on Bloomberg Business Week Daily. We'll see you again, same time, same place tomorrow.
And we will continue to digest some of these earnings, particularly from Alphabet. We have with us Caroline Hyde, co-host of Bloomberg Technology, who has been combing through the results as well as combing through IBM's results. Why don't we start with Alphabet here? Because the stock is lower, although by every measure, it seems like the revenue from different businesses did beat analyst estimates.
And maybe it's the run-up in the stock that we've seen. Remember, prior to today, we had 10 straight days of gains on Alphabet. We've actually seen a real increase in the share price over that time frame. So maybe we started to build in this enthusiasm that we've seen in terms of, yes, it's a slight beat from the street in terms of their revenue going forward. I think the increase in capital expenditure, basically Mandeep Singh, shout out to Bloomberg Intelligence, he had it exactly right. He said they're going to uplift it from 10 to 15%. They've uplifted it by 13%, coming in at $85 billion, basically in line with where the rest of the hyperscalers have been adding to their capital expenditure. But maybe people just want to continue to hear, okay, you've really got this confidence in investing in the infrastructure, but the headwind remains, well, the antitrust investigation. We've got to wait until August to really understand what Judge Mehta is going to make of that at the very earliest. Exactly.
Just want to bring in IBM for a second, Caroline, because essentially all the results that we got so far this session have been pretty decent, right? If not excellent. IBM, however, though, revenue coming in at $16.98 billion. That was a little bit of a beat. Free cash flow was also a bit of a beat, but in terms of consulting revenue, it was also a beat. So we are really seeing, a lot of positivity here.
Yeah, and I think you'd see Arvind Krishna himself, the CEO, saying we're really positive on this. They said the makeup of the revenue was very good.
Because we got Tesla results coming out as well. We'll get back to Arvind Krishna for a second. But right now, Tesla's second quarter EPS of 33 cents, a drop from 42 cents last year. That adjusted EPS number of 40 cents, missing the consensus estimates by 2 pennies. As for its revenue, $22.5 billion. Analysts were looking for $22.64 billion. And that's clearly a reflection of the slowing sales in autos. And of course, Tesla gets 85% of its revenue from car sales. Gross margin in the period, however, was higher than anticipated, 17.2% compared with the consensus estimate of 16.5%. So again, Tesla, when it comes to the EPS, missing the average analyst estimate there, 33 cents versus the expected 42 cents on a year-over-year basis, 40 cents versus the expected 42 cents on an adjusted basis.
Yeah, so while those metrics didn't meet the estimates, it does appear that the stock is moving on this gross margin beat, right? Because that essentially is what's going to keep Tesla going in future quarters. If it can, make each car cheaper to produce and have a better margin, then that's excellent for shareholders. The stock is bouncing around after hours, but it's been bouncing around higher for the most part.
Caroline, what do you look at when you look at Tesla results? I mean, the margin is something certainly that's very encouraging, but it's all about the commentary related to the robotaxi, related to the humanoid robot.
And I think you've got to put in the context that this is basically the worst revenue decline that we've seen in more than a decade. This is a company that has trailed the rest of the Mag 7. Share price has been significantly under pressure. So maybe a lot of this negativity has been baked in. The delivery numbers was woeful a couple of weeks ago for the fiscal second quarter. We need to hear from Elon Musk what ultimately is the end game here, because as we've heard from, Data Trek, for example, will point to the fact that this is a company that 95% basically trades on future. Not on the here and now, not on the fundamentals of the business, but on the promise of robotaxis, on the promise of where we see Optimus, the humanoid robot, go. what's going to be really interesting coming from Elon and the executives is how bad is the energy business going to be affected by tariffs? How bad is the overall profitability going to be hit by the fact that you're pulling back on, well, support for the EV business, forcing, of course, prior to this, car companies to come to them to buy the regulatory credits from Tesla because they're the ones with all of the excess. Well, now that's no longer going to be necessary. Are people going to bring forward in this fiscal quarter their buying of a Tesla because by end of September, that $7,500 in regulatory credit you used to get is no longer going to be in existence? So there's a lot of a pull forward factored in for the here and now, but in the longer term, how are we going to make up for a lost profitability that's meant to be sustaining the innovation and the AI focus of Tesla going forward?
A good story is going to make up for all of that.
It usually does, to be perfectly frank.
All right, Caroline Hyde, co-host of Bloomberg Technology, thank you so much for the instant analysis. We're going to continue this conversation now on Tesla and bring in Ross Gerber. He is president and CEO of Gerber, Kawasaki Wealth and Investment Management. He has a stake in Tesla. And Ross, you are a former Tesla bull turned bear on the stock right now. When you look at the results, what do you pay attention to today?
Well, there's the sort of reality, and then there's the medium term, and then there's the hope of the long term. And the reality is that the business is in decline. I don't think we need any more evidence that their traditional EV and energy business is in decline. And it's really sad, and it is mostly related to Elon's, interesting way of marketing his vehicles, which has turned off most of the people in the world. And we're just seeing, sadly, a continued decline in the business. On the medium term, we hope that maybe things will get better, but the truth is everything's going against Tesla once we get past this next quarter, which your previous guest was just discussing the fact that in a month and a half the credits go away, and Tesla's going to enter a new reality where it's going to be much more difficult to sell cars just because of the pricing. And then on the long term, what Elon and what the Tesla bulls really want you to focus on is the opportunity in robo-taxi and robots, which obviously is a long time into the future and hard to quantify.
Yeah.
And so as long as you keep looking really far, far ahead, you can kind of try to find some positive here. But if you're looking at the short and the medium term, it's not really that positive of a story.
Well, let's look at what's happening right now, which is free cash flow. For the period, Tesla says second quarter free cash flow was $146 million. Analysts were anticipating $760 million. That's quite a huge difference, and it's also a drop-off from $664 million in the first quarter. Does Elon Musk care about free cash flow? Do you, as an investor, care about free cash flow?
Well, everybody cares about free cash flow if you look at your own checking account, right? So free cash flow is an important metric, and Tesla has been a highly profitable company in the past with great margins if you just go back 3 years. So, yeah, these are all problematic any way you want to slice these financials. And I still think many of the earnings estimates for next year are fantastical at this point when you add in the lack of regulatory credits, the higher pricing of the vehicles, and the general negative sentiment of the business. The idea that Tesla's going to sell, 20 or 25% more cars next year, I think is somewhat fantastical as well. So as I said, I love Tesla as a business. I care about the EV business, and I care about climate, and I'd love to see Tesla selling, tons of cars and being wildly successful, but they're just not doing what they need to do to sell vehicles.
Ross, out of earnings, we're also seeing the cyber cabs scheduled for volume production starting in 2026. Now, we don't know whether that's January or December 2026, or whether it even matters if there's a month put down. But let's say it's early 2026. Is that early enough to meet and beat Waymo?
Well, the answer to this is still yet to be determined, but I would argue at this point Waymo is well ahead of Tesla. Let's be real, Tesla cyber cabs don't work yet. They have safety monitors in it. They're still mapping. So they're kind of where Waymo was 2 years ago. Waymo was doing the same thing here in Santa Monica with people in the cars, and they were driving around mapping everything. And so if you just extrapolate out a similar timeline, Tesla's several years behind Waymo, and whether they can catch up or not is yet to be determined, because I don't think their software-hardware combination is going to be good enough to work and scale, and that still is yet to be proven. I could be wrong, which I hope I am as a Tesla shareholder, but I think Tesla's going to have a lot of problems. And so the Cybercab will be important for them because they'll have to have different types of hardware on the Cybercab to really get it to work. And so if they launch a new vehicle, they can embed that new hardware in the vehicle. But it still comes down to people want to drive cars. I don't think they're expanding the market for people ride sharing, and people want their own vehicles, and Tesla needs to come out with a lower price vehicle. This is crucial to their success long term in markets like Europe. They need a small, low price vehicle. They've been talking about it, they promised it, they teased it, and Elon's just kind of like pushing you down this robocab route because he can't sell cars.
We're getting some more margin information. So the second quarter automotive gross margin ex regulatory credits was 15%. Earlier we had a gross margin come in at 17.2%, which was better than the estimate. Do these kinds of margins excite you as a shareholder, Ross, in the sense that they are at least better than they were and the ex regulatory credit mightn't be as bad as some feared?
Well, I mean, we used to brag about having 20% margins on the car. So, you know, I guess any margin at this point is pretty good for Tesla. So, you know, I don't parse numbers that, how would I say, close. The way I look at it is the overall trend of the business is down. And that is the real troubling issue. Whether it be margins or sales or whatever metric you want to use, the overall arc of their core business is down. And to hope that robo-taxis are somehow going to replace EV sales as the core of Tesla's business is a long time coming, and probably not a reality ever. If you look at the size of Uber's business, I would rather be Tesla than Uber any day of the week. Like, if you actually think about it, like logically, would you rather be Tesla selling $100 billion worth of vehicles at a 15% margin, or Uber with a ride-sharing business with much lower margins and an extremely difficult set of circumstances? So, you know, I still think Tesla should focus on its core and refocus on improving its image and with consumers, because people still want Teslas and they're still buying Teslas to some degree, you know. But as I said, people really dislike Elon until they want to address and rectify that. I get you can go onto Twitter and get your followers to say how great you are, but if you walk out on the street, you know, it's a different reaction when you mention Elon Musk. And so I think until that's solved, it's going to be really hard for Tesla to sell cars.
All right, Ross, thank you so much. We'll speak to you again soon. That is Ross Gerber, President and CEO of Gerber Kawasaki Wealth and Investment Management. And sticking with Mag 7 results, shares in Alphabet now are down 1.1% in after-hours trading. Joining us to discuss is Scott Devitt, Managing Director of Equity Research at Wedbush Securities. Let's ignore the sort of immediate share price impact, Scott. Obviously, according to you, Google is a little bit undervalued at the moment anyway. Could you have imagined a better report beyond the CapEx spending, which maybe investors think is a little too high? Everything beat.
Right. I think the only negative, which you highlighted earlier, is that the stock's been up 10 consecutive days going into today, and so the market sniffed it out. But you had the search business, 12% growth accelerated. YouTube, 13% growth accelerated. The Google Cloud business was 32 or 33% growth, also accelerated. So it's kind of every box to check in terms of growth, and where the core risk is on the search business looks to be in a good place right now. The only knock would be operating margin percentage was slightly below expectations. They did beat on an absolute basis because revenue beat. There was a one-time expense in the quarter that they didn't quantify that could be a factor there. And then the CapEx guide being higher, for the year, maybe a little bit of concern around profitability. But I mean, this is a stellar report.
I'm wondering how you see AI factoring into the ad revenue. Alphabet saying AI is positively impacting every part of the business. But heading into this report, certainly not in the last 10 days, but earlier this year, the concern was that Gen AI was eating away at that search business, eating away at that revenue, that people were no longer doing Google searches. They were just asking ChatGPT questions instead. How do you see AI playing into and boosting its search business?
Well, I think this whole AI, transition that we're in is in kind of this hypothesis phase now, where anybody can say anything, because it's not necessarily supported in facts, because nothing's really happened yet that's quantifiable. But with Alphabet, what they've done kind of miraculously and not been given credit for is the integration of AI overviews into search and then the launch of AI mode into the results as well. So search queries are just shifting within Google. Maybe the denominator overall is getting bigger because AI is a new use case for consumers, but the growth in query volume for Google is more sound than investors believe. And Google will be able to, and has already said that it can monetize AI query volume over time better than legacy search. It reminds me quite a bit of the transition from desktop to mobile, when there was a lot of risk in companies perceived like Alphabet and Meta, but ultimately it ended up being a net positive. And I think that's what we'll find here with Alphabet as well.
Yeah, so I mean, it's uniquely positioned to have, it's Gemini on all of these apps, right? Chrome and Gmail and so on. So that part is sort of taken care of. What's the biggest risk then going forward for Alphabet, Scott, if it's really just blowing it away on search, on YouTube, on advertising? Even other bets isn't doing so badly when you look at Waymo.
It's continued execution. I think the market's now beginning to respect that the company was actually working on things to address this AI transition. It just wasn't all visible to the market at any given point in time. Now that's clear. If the company can manage the margin profile through this transition as it continues to ramp up spending, it's historically run fat as an organization relative to some of its peers. Meta cut much more aggressively in the 2022 period. And so I think there's a lot of ability for Alphabet to manage costs as CapEx continues to rise and show moderately improving operating margins with very healthy growth. And so, I think the backdrop for the stock now is quite good, despite the moderate pullback after hours.
All right, Scott Devitt, really appreciate your joining us to give us your instant analysis here of Alphabet, Managing Director of Equity Research at Wedbush Securities. And of course, we want to hone in on the advertising part of the business for Alphabet, because ad revenues from Google and YouTube both beating analyst estimates, according to the latest earnings report. Let's talk more about the future of digital advertising with Mark Douglas, CEO of TV advertising software platform Mountain. And Mark, of course, joins us live. Mark, in terms of the YouTube ads revenue, $9.8 billion. What was anticipated was $9.56 billion. And we saw from Netflix's report as well that YouTube is the one thing that it stands in its way from being the dominant player in the streaming business as well. Talk a little bit about YouTube's ad outlook here, especially as we question whether there's going to be any kind of pullback in the economy down the road.
Yeah, well, I don't think YouTube really competes with Netflix. I think for most people I know, they use both. In other words, that YouTube has a lot of short-form content, mid-form in terms of length, and Netflix are shows. They are big titles, new shows every week. It's professionally created. And so both can coexist, and both do coexist. Mm-hmm. I think YouTube is obviously doing really well in terms of number of hours spent on it. It's always, ironically, underperformed in terms of the revenue generated from it, because those pre-roll ads just honestly don't perform that well. They don't have great retention, things like that. But despite that, YouTube continues to grow the revenue moderately. I think 13% year over year in this quarter. So yeah, it plays a role. It's nowhere near as important as the search business, and I don't think it threatens the streaming business. Certainly not Netflix. It's a complement to the user in terms of how to consume content.
Fair enough, fair enough. Just to stay with the YouTube revenue for a little bit here, it sounds like they have a couple of levers they could pull, though, if they wanted to increase monetization, certainly of those who do tune in.
Yeah, well, the big thing to look at YouTube, the customer base looks very different than the customer base for search, where search has this enormous long tail of small advertisers, obviously big brands also. YouTube just simply doesn't. I mean, most of the brands you see on there are larger brands. They're more brand advertisers. And so can they increase monetization? I think they can. I wouldn't be betting on it as an investor. I feel like with YouTube, just even broaden the conversation, every quarter is like waiting, is this the quarter where like something catches up to them. Does AI catch up to them? Does maybe YouTube advertising slow a bit more and things like that? And so you're kind of always on the edge of your seat right now. And I think that getting out of that mode is the biggest thing facing the company, and honestly the biggest thing I think facing anyone, investors in Google, is like getting out of that mode where what's going to happen this quarter? Is this going to be the quarter where reality catches up right now?
Mark, text-based advertising is the biggest contributor to its top line. Is that too much of a concentration risk? Does it need to do something about that to assuage investors?
Yeah, I mean, I think that speaks exactly to what I was just referring to. Is so obviously search continues to be vitally important to literally millions of businesses, and all of these Google has to somehow transition all of these companies onto their AI solution, and they have to do it flawlessly in order to not disappoint both their customers and then ultimately their investors. And so, yeah, I mean, it's inevitable. It's still going to be text-based ads in the form of AI ads. I mean, they could be audio, like your AI is literally talking, Gemini is literally talking to you, but it's just a huge risk. And I think they're showing that they're going to do whatever it takes to figure it out and not only survive but to thrive. But it's going to require flawless execution.
Well, they certainly have allocated more to capex than investors were anticipating. So maybe some of that capex is going to go towards these kinds of innovations, let's say. But Mark, when it comes to the cycle of digital advertising spend, who's spending the dollars right now? Where are we in that cycle, and who's spending most?
Yeah, I think so. Right now, it's kind of business as usual. No one's kind of pulling back or aggressively moving forward. So that's a good state to be in for the whole market. For Google, for Meta, my company Mountain. I mean, it's the small, mid-sized advertisers that dominate where the money is spent. And so the big brand advertisers, they don't increase their budgets much, whereas smaller and mid-sized business, they increase their budgets essentially at the rate they grow. And so Google, that's who Google's catered to. They built that market. Google essentially invented digital advertising, and so, or at least made it as big as it is today. And so those customers are spending. They want to grow. 2025 started rocky. It's looking great, like a great year, and they are spending heavily. Brand advertisers are just steady state, and they're not pulling back, so nothing to worry about there.
All right, Mark, always lovely speaking with you. Thank you so much again for joining us. That is Mountain CEO Mark Douglas. Still keeping an eye on shares of Tesla following results from the EV maker, down 1% now. The company coming off a wild first half of the year, featuring a string of executive shakeups. Many senior leaders exiting the company, leaving investors questioning if there's more tumult happening beneath the surface. Joining us now to discuss is Steve Westley, founder and managing partner of the Westley Group and former Tesla board member. So should we expect more departures, Steve?
Well, I think we may. Look, it was another tough quarter for Tesla. Unit sales down 14% year over year. Q2 revenues coming in, we think at about $23.5 billion. That's down 8% year over year. On track for $97 billion in total revenues. So what you have here is flat growth. And when Tesla is hyping itself as a hot tech company, which I think it is, it's hard to sell the flat growth story. So they need to keep top executives in place. They need to get new product to market. That's the challenge for Tesla. We'll see if they can do it.
They need to get new product to market, and it's not happening, certainly when it comes to the auto business, which very much still drives its top line. Do they have the talent in place to do that right now, Steve?
Well, I think they have the talent, but they do need more stability. You just can't have this many of the top executives going out the door. And I think to the extent Tesla can play down the drama and focus more on executing, it'll win. I think they need to do four relatively simple things. First, they need the new $25,000 model that can compete with the lower cost Chinese and also legacy makers like Volkswagen and Hyundai. They've got to get regulatory approval for the robo-taxi in Austin and San Francisco. They need that ASAP. They need to rebrand it, less drama, less politics, more new products, lower prices. And then, and this is an important part of it that sometimes gets lost, they need geographic expansion. They've got to launch in emerging markets. And they finally launched in India, but to do well there, you need to do what BYD and Volkswagen and others have learned to do, is show up with that $20,000 to $25,000 vehicle that people in Vietnam, India, South America can buy. If they can execute on any of those four things, their prospects are going to look a lot brighter. But now they need less drama, more execution.
Right. Instead, we get a lot of focus on the robotaxi and the humanoid robot as well. There's also a new focus on the Bitcoin holdings of the company, too. In the second quarter, Bitcoin actually rose in price, so that should be a net positive for the company. How much credit will investors give to Tesla on that Bitcoin angle?
You know, that is such a new one. Who's to say? Bitcoin's real, it's the future, but it's still, are you investing in an auto company or a speculator? And I think that's going to be a hard one for people to get their arms around. At the end of the day, I think investors are going to be looking at, is this auto company providing growth for the future? Are they providing increased profitability or lower profitability? And are they at the front of the pack for bringing new models to market, cutting costs, providing better features, longer ranges? They were at the top of every category in 2021, 22, and 23 with the Model 3 and the Model Y. They need the next generation of new product with a wow factor to get back to where they were. We'll see if they can do it.
Steve, what makes you think there's any kind of premium on stability, whether it be at the board level or in the executive C-suite? I mean, we've had people like Kimball Musk on the board for decades. James Murdoch is on the board, for example. It's essentially a board that's kind of locked in. The only new board member is John Hartung. And as for executives, I mean, does it really matter? It's Elon Musk who calls the shots at the end of the day.
Well, look, big companies like Tesla are more than one person, but it just doesn't help that they've had so many of the top people, especially highly respected folks like Drew Baglino, leaving. That shakes up investors, and that's part of why Tesla's lost 20%. They would benefit by having stability in the top ranks. I don't know anybody that disagrees with that, but they have a lot of talented people. They own a lot of things that many people don't understand. They essentially own the North American charging network. That's a coup. That's going to give them a profitability buffer. They were a leader of auto companies any place in the world to develop a robust energy division that's not only selling power walls for car users, but is selling $1.5 million gigapacks that they're selling to utilities around the world by the thousands. That's sort of the hidden hero in their revenue story. So they've had a few misses, but they've got a lot of insurance policies, including their bets on Bitcoin. But at the end of the day, the whole world is going electric. Tesla and every legacy automaker needs a $20,000 vehicle in the developing world and a $25,000 vehicle in the European and North American markets to win. And everybody's waiting to see whether Tesla's going to roll one out or not.
Yeah, it's been promising for a while now. Steve, always appreciate your joining us. Thank you so much. Steve Wesley is founder and managing partner of the Wesley Group and a former Tesla board member. All right, Steve mentioned that the whole world is going electric, so let's continue the conversation on electric vehicles, but more specifically, autonomous vehicles. A hot topic this afternoon, certainly with not just Tesla reporting, but Waymo parent Alphabet out with results as well. You can see the stocks, little change at the moment, at least for Alphabet, and Tesla paring some of its losses now down 0.3%. Robotaxis, of course, going to be top of mind for investors ahead of the conference call for Tesla at 5:30 p.m. Eastern Time. Let's bring in right now Stephanie Valdez Streaty, Director of Industry Insights at Cox Automotive. Stephanie, we just heard our previous guest talking about this idea that the whole world is going electric, and a $20,000 vehicle in emerging markets, a $50,000 vehicle in developed markets is crucial for Tesla to maintain its market share. What is the evidence that we're going to get something from Tesla in the next quarter or two?
I think we'll find out more later on today, but like your previous person that spoke mentioned that there's a price premium, and those OEMs that are able to launch an affordable EV are going to really excel. And so I think Tesla, they've been promising it. Their Cybertruck, it was very niche, so that didn't really have mass adoption. And so I think it's going to be critical for them to really innovate and get something that's affordable under the 30,000 mark that's going to resonate with the market.
Can they even afford to do that, though? I mean, with free cash flow at $146 million, that feels like chump change compared to $664 million the first quarter a year ago, Stephanie.
Yeah, Tesla has a lot of headwinds. Not only do we have, the economic headwinds with tariffs and, high interest rates, consumer sentiment, uncertainty, all that. But they also have, if you think about just the transition to electrification, just consumer adoption barriers. But the one thing you talk about profitability, if the California clean waiver goes away, Tesla has definitely profited from having those carbon credits. And so that could be a big hit for Tesla. But the one thing I will say about Tesla is that they have been profitable and that carbon credit has helped, but they have vertical integration. And that is one thing that they have, in terms of the other manufacturers, they'd be able to own most of their supply chain. They're building batteries. So it's all going to be about execution. And, we keep hearing all these promises. So it's really going to proof in the pudding, right? Let's get some execution and see some of these promises come to fruition. That's going to be key for Tesla.
Stephanie, what's the second-hand market for Teslas like these days? I mean, is the demand there for used Teslas?
Oh, gosh, yeah. Tesla, I think the used market follows the new market, right? And so Tesla is dominating. Even though their share has declined since 2020, they're about 44% of the market in the new market. Those vehicles go into the used market. And so the Model 3 is one of the top-selling used EV, on the average pricing about $23,000. So if you think about the Teslas that are coming off lease, they've been leasing more. There's a lot in the market. And if the overall value, if you're a consumer that wants an EV, a used EV is a great option because you're getting it for a really good price point, plus you're getting all that great tech. So it's a really strong value proposition. So the used EV market is going to continue to grow. And so I think we're going to continue to see lots of Teslas in that market because of their impact in the new market.
Let me just jump in here because we do have earnings as well from Southwest Airlines. Second quarter adjusted EPS of 43 cents, missing the consensus estimate by a dime. Operating revenue of $7.24 billion, also lighter than anticipated. That was going to be $7.3 billion according to analysts, but again, the number coming in at $7.24 billion. As for the full year, Southwest sees full year adjusted, not adjusted, EBIT at $600 million to $800 million. And the board has authorized a new share buyback program of about $2 billion. In addition, some commentary here when it comes to the revenue from bag fees, which of course is a new thing. If you were a Southwest flyer a couple years ago, that did not exist, but they were under pressure to add this auxiliary revenue. Bag fee revenue, according to Southwest, exceeding analyst estimates. Passenger revenue for the quarter, Vani, was $6.63 billion. That was slightly higher than anticipated.
Yeah, and shares are lower by more than 4%. The board also authorizing a new $2 billion share buyback program. We've seen that from a few companies this quarter. Stephanie, Valdez, Streaty, let's get back to you on Tesla. How will Tesla get buy-in from regulators? Will it? Is that a foregone conclusion?
I think it's going to have to be how their pilot goes, the results from the pilot, right? I think that's the one advantage. Waymo has trust in the market from regulators. So Tesla's going to have to really, I think, to figure out what's that roadmap to expand these robotaxis beyond Austin and really get those results from those drivers now going on in Austin, Texas, to really show the results that they are safe to drive and that they can expand to other markets. So I think that's going to be critical. Just showing the results of this pilot they have going on in Austin is going to be key. And I think also, just not only with regulators, I think there's a lot of just trust in the community, in the brand, right, for this FSD, stuff like that. So I think they're going to have to put together a plan. How do they overcome mistrust in the market around their autonomous vehicles?
All right, Stephanie, thank you so much for joining us today. That is Stephanie Valdez Streaty, Director of Industry Insights at Cox Automotive.
All right, it's a little bit overwhelming here, the number of earnings that have crossed in the last 40 minutes or so. So let's try to put it into context here. Alphabet, the lone gainer of the bunch, gaining more than 1% in after-hours trading right now. And this is, different businesses beat analysts' estimates kind of across the board. Remember, this is a stock that had been up for 10 straight days before pulling back a little bit today. So far, the stock is up higher in after-hours trading. We're also hearing from IBM. That stock lower by more than 5% right now as revenue did come in slightly higher than analysts' estimates, but people are saying that it was lukewarm in terms of their software results, and that kind of dimmed some investor enthusiasm. And Ronnie, we're also seeing big declines here in Chipotle, which we haven't brought up just yet. Chipotle still seeing full-year new restaurants at 315 to 345, so that expansion continues here. But in terms of revenue for the quarter that ended, $3.1 billion, matching the analyst estimates, and comparable sales, unfortunately, down 4%. That was a bigger than expected drop. Analysts were looking for a 2.9% decline. Mattel, the toy maker, also coming out with results lower by 3.5%, even as it resumes its 2025 guidance, which it had pulled because of uncertainty over tariffs. This is the close on Bloomberg.
I think this AI action plan is really a call for all of us to come together between public sector, private sector, bringing our best technologies, bringing our best ideas, open ecosystems, and to come together and really, solve some of the most important challenges in the world.
That was AMD's Lisa Su sitting down with Bloomberg's Ed Ludlow ahead of tonight's AI address from President Donald Trump. Joining us now from the event is Ed Ludlow, co-host of Bloomberg Technology. So it appears that many of the CEOs that were there are very positive and expressing sort of graciousness and gratefulness that this action plan is being put into place, Ed. Is that right?
Yeah, I think what I discussed with Lisa Su is that she's read all 23 pages of the action plan and that she thinks it's actionable, which is why not only when the president speaks later this evening we'll be paying attention, but we also expect executive orders that basically speak to the core of the AI action plan's underpinning, that is to deregulate, cut red tape, and a specific focus on energy, right? We are talking about data center infrastructure, and every government official that I've spoken to here, every CEO is basically like, what President Trump is doing is allowing this industry to move quickly. There are not universal answers here, though. One of the areas that the action plan focuses on is the idea that America should export its technology, the American technology stack, even if that is to economic adversaries like China. And the way that Lisa Su described that to me was to call it a tricky dribble. She thinks that the administration, in particular, Commerce Secretary Howard Lutnick, but also Vice President J.D. Vance, have done a good job in making policy where suddenly American tech companies can provide their technology to nations like China, or we've done a lot about the Gulf and the Middle East, but it hasn't been easy, and there is more to come, and a sort of codified and uniform strategy that replaces the diffusion rule. But that's the underpinning here. Everyone is convinced that whatever the president goes on to announce in terms of executive order, the basis of the document that was released today is evidence that America will move quickly in order to allow the private sector to build a lot of infrastructure and export AI technology, both hardware and software, around the world. And that's what we tune in for when the president speaks later this evening here in Washington, D.C.
All right, Ed Ludlow, really appreciate your giving us a preview of that. When the president speaks, of course, Bloomberg's Balance of Power will be taking you to his comments live. Ed Ludlow is co-host of Bloomberg Tech. Joining us now to continue the conversation on AI in Washington is Meredith Broussard, professor at NYU, who is also the author of Artificial Unintelligence, How Computers Misunderstand the World. And Meredith, your research focuses on AI in investigative reporting with an interest on using data analysis for social good. We were talking with Ed Ludlow about how the industry is focused on providing AI technology. You're concerned about the application of the technology as well. From where you sit, what does the AI action plan look like for users of AI data?
Well, so this plan has 3 pillars. It's about innovation, infrastructure, and the U.S. leading in AI in diplomacy and security. And basically what's going on here is that it's government handouts for big tech. This action plan says let's do unrestrained capital spending on artificial intelligence, on building data centers in the service of this kind of questionable AI race, and it's primarily to the benefit of Silicon Valley.
Yeah, I was just going to ask you about MAGA language in the plan. How does that sort of interfere, if at all, in the AI action plan? I mean, these LLMs, they're supposed to be a little bit neutral at least, right?
Well, so what happens with an LLM is you take a whole bunch of data scraped from the internet and you dump it into the computer. You say, computer, make a model. It makes a model, and then you can generate new text or images or video or audio, whatever. And one of the things in the AI action plan is that it says that the models need to be objective, that the information that they generate should be objective. And it especially says this if they're going to be used by the government. This is going to be a huge problem because there is literally no way to make a generative AI system generate only objective truth. Because the only place we have objective truth is really in mathematics, right? And LLMs are really bad at math. Right, so by saying,
ironically,
yes, I know, it's pretty wild. Older AI was much better at math. So by saying, okay, these LLMs have to generate objective truth in order to be used by the government, it's actually stifling government use of AI. Now, the other thing is that there is literally no way to make a generative AI system generate things that are true because it's trained on data from the internet, right? If we wanted truth to come out of LLMs, we would have to fundamentally change the structure of the internet, right? And I don't see that happening.
One other thing that the administration is pushing for is to get AI into schools, part of public education as well. Given what you just said, how do you see that playing out across school systems in the US?
So I see that as a cash grab by ed tech companies. By saying, oh, we need to put more AI in schools, we need to train teachers on how to use AI, that's putting money into the pockets of the people who provide the AI training, the people who provide the AI solutions. It's not putting those dollars into schools. And so, for example,
in the same way that laptops and Chromebooks and tablets were provided by those companies to put in schools.
Exactly, to get kids hooked. And now there's another wrinkle that happens that people often don't think about, which is electricity in schools. So in New York City public schools, a lot of public schools don't have air conditioning, right? Their electrical grid is so out of date and so underpowered that they can't actually support an air conditioning system. And you know what you need in order to have computers in schools? You need air conditioning. Otherwise, the computers overheat. So there are all these things that have to happen in schools before you can get every single kid using AI. And another point, as a professor, AI is not actually that hard to use. So I'm not sure we need all of this, huge amount of training in K through 12.
Does it matter that the president has an AI action plan? I mean, so many countries have something similar, or equivalent, or at least the promises of something. It's up to the private companies at the end of the day, right? What they do with AI.
Well, one of the things they're going to do with AI as a result of this plan is this plan basically allows for unrestricted spending on building data centers. And so AI companies, big tech companies, are looking to build data centers in order to get more power for their artificial intelligence systems. But what happens when you build an AI data center is it requires a huge amount of cooling. We're really talking a lot about temperature today, right? It's very hot out. So you need to cool down these AI systems with water. You can recirculate the water 3 or 4 times, but then you need to spit it back out. And what happens in the communities that are next to these data centers is it uses up all the water. It's much like fracking.
Yeah, and it's a bigger issue in certain parts of the country as well, particularly places like California and Nevada. Thank you so much, Meredith. Always a pleasure speaking with you, giving us a different angle here from what the industry is pushing forward. Meredith Broussard is professor over at NYU. Now, still ahead, we're going to set you up for what you need to know for the next 24 hours. This is The Close on Bloomberg. All right, let's look ahead to what else we're watching over the next 24 hours. American Airlines will be reporting, Keurig Dr. Pepper, LVMH, which should be really interesting when it comes to the luxury consumer and the fact that European and U.S. negotiators are getting closer to a trade deal.
At Intel, Scarlett, can't wait to see what Intel is going to say, a struggling company over the last several quarters. We also, of course, get the ECB rate decision, so that will have some effect on how the euro is trading as well at 8:15 a.m. Eastern.
And here at home, new home sales come out, as well as initial jobless claims and manufacturing PMI from S&P Global.
And the pipeline of IPOs continues, with Accelerant Holding expected to begin trading under the symbol ARX.
And right now, just a heads up that we are awaiting President Trump's keynote speech at the Winning AI Race Summit. We will have full coverage on that beginning on Balance of Power coming up next. That does it for us. Have a great evening, everyone. This is The Close on Bloomberg.